thing about fixed income is interest rates are lower now than where we began this year, but I'm wondering if we end the year with the 10-year back around 3%.
I think we do. I think we actually see the 10-year maybe even slightly above that at the end of the year. There's been a number of factors to help push yields, not only at treasuries, but across the bond market lower year to date. You talk about geopolitical risk in the Ukraine, slower growth in the first quarter, that's come back, low inflation. But let's keep in mind the Fed's on track to taper. Low inflation is likely behind us. Inflation is likely to creep higher, and the economy will continue to improve. So yields should gradually push higher from here, and that's going to limit opportunities for bond investors over the second half.
In terms of limiting those opportunities then, Anthony, what would you recommend that clients start doing with their fixed income investments, or should they have done it already?
Well, I think they should. Now is actually still a very good time to make some modifications, specifically in light of the fact that there's very little opportunity across the bond market, not just treasuries. We're talking higher valuations in munis, higher valuations in high yield bonds, corporate bonds. There's just much less opportunity. So to protect against or reflect that lack of opportunity, you should have some intermediate bonds to start with. Core bonds, that's to protect against an adverse shock in case we do get a fall in equities. Those bonds will provide good diversification benefits. But pair that with lower rated debt like bank loans and high yield. Now granted, high yield's a little expensive but has historically done well in a rising rate environment. It's still supported by a low default environment, and companies are still very healthy. So I think that those are the areas you want to complement a high-quality bond portfolio with. So look at those lower-rated sectors which have historically done better in rising rate environments. So that's the best way to maximize return in our view over the second half of this year.